Great. Now, we are going to look at the redeemable. And when we are talking about redeemable bond, these are bonds which have maturity period. They have maturity. At the end of the day, these bonds can be redeemed or can be converted. At the end of the day, these bonds can be redeemed or converted. Redeemable bonds. Redeemable bonds. You see? So we need to be very keen with the question. If a question has a maturity period, note that this is a question of a redeemable. The bonds can be redeemed. After the maturity period, we can get it back. We can get it back, or we can convert it to other security, So let's say that these bonds have maturity period. That's the key. These bonds have a maturity period. They do mature. So you will easily identify them. They have maturity period, full stop. They would therefore attract we don't note. Already. We have the notes. Great. Great. Thank you so much. So already you have that. Okay. I gave the assignment. Okay. Assignment, did we do an example? That is what you could have told me when we were starting, eh? Okay, all right. Okay, assignment ilikuwa gani? One example. Okay, one example. Great. Okay. All right. Richard's woken up. Yes. All right. So. Sasa ndio watu wameamuka wakati tumeanza, eh? All right, ni sawa. There's no worry with that. So Redeemable Limited has issued a 20-year bond, right? Is that the question? All right. Sawa. So let's do that question together. Redeemable Limited, for the sake of the new student, allow me just to write down this question. All right. Anasema just woken up. Ndio akili imekumbuka. Thing we have done. Haya. Redeemable Limited has a 20-year bond, as a 20-year bond, with a nominal value of 1,000 shilling. With a nominal value of 1,000 shilling. With a nominal value of 1,000 shilling. And coupon rate annual rate of 9%. Coupon payment are made on payment are made semi-annually in arrears. Semi-annually in arrears. The yield to maturity, the yield to maturity, the yield to maturity, the yield to maturity, YTM of the bond is 12%. Is 12%. 12% per annum. Use YTM as the KD. Required, required to do, required, one, the value of the bond. Number two, the new value of bond. If yield to maturity goes down to 8% per annum. Goes down to 8% per annum. Great. Great. If yield to maturity goes down to 8% per annum. That was the question. That was the question that I give assignment from, and we are going to do it together. Class, if you look at this question, is of course it's under redeemable topic or section, under redeemable section, but is it a conversion question or a redemption question? After the end of the maturity period, are we going to redeem the bond or are we going to convert? Somebody. After the end of the maturity period, are we going to redeem the bond or are we going to convert? Somebody. Are we going to redeem the bond or are we going to convert? I want several individual. Redeem Annette, Grace, redeem Joseph. Thank you so much. You see, if you look at this, there's nowhere you've been given information about conversion. Examiner, if the examiner want you to do the conversion way, you will be given information about the conversion. But remember, a conversion question or the question with the conversion information, we shall also do the redemption. Right? Remember, at that point, you'll be required to get the ceiling value, the highest value, and the lowest value. So the thing is, you compute or you get the conversion value, compare it with the redemption value. The one which is higher, the one which will give the higher return, it is the one that we do what? We used to compute the ceiling value. We used to compute the ceiling value. We shall look at a question under that. So for this one, it's just under redemption, and we're going to use the formula MV is equal to interest times PV. We discount our interest, KD and N years plus redemption value. Redemption value, I also need to discount that with PV, KD, and years. That is the formula. The formula. The formula. Now, I'm able to start with the first one, Roman number 1. lemma number 1. So always start with the formula and it will be good. So let me first of all get the interest. How do I get my interest here? To get the interest, I was told that this is a 20-year bond with a nominal value of 100. Nominal value is the same as par value, is the same as redemption value, nominal value, fair value, like that. Therefore, 1,000, coupon annual rate of 9%, coupon payment are made semi-annually. Now, I need to consider this, that the coupon payment are made semi-annually. Therefore, I need my 9%. Since it's semi-annual, it will be paid twice per year, times 1/2 times the 1,000. So how much will be my interest? That is my interest. That is what I'm getting as the interest if I work on that. 45. 45. Our interest is 45. And I know my redemption value ni ngapi. I want somebody to give me the redemption value. Redemption value, because I need it. What is my redemption value? 1,000. We say redemption value, par value the same. Shilling 1,000. Then done. I'm going to discount my interest. That's formula 1. I'm going to discount my redemption value. Done. Is it 100? Was it 100? 1,000. Now, can you tell me, for my redemption value, why am I discounting using PVIF? Why am I discounting? Somebody to give me the reason why I'm discounting my redemption value using PVIF. PVIF, present value interest factor. Why? Those are some of the things that once you answer, it becomes easier. Why are we using PVIF? Standalone, a lump sum, it's a one time. I like that. It's a one. You just redeem once at the end of the maturity period. You just redeem once. It's a one time. It happened at the end. For the interest, we shall earn interest mwaka ya kwanza, ya pili. By the how many years? 20. You shall be redeeming this interest 45. Kila mwaka hivyo. So it's an annuity. This one interest is an annuity. And therefore we discount using PVIF. Great. Having known that, we can come here and now say our MV will be equal to 45 times 1 minus 1 plus our KD. Where is our KD? I've forgotten to divide my KD. KD still is 12% divided by 2. Don't forget, raised to negative 20. Of course, 20 times 2. 20 times 2. The number of years will also double. Plus redemption value of 1,000 times 1.06 raised to negative 40. I've just put negative 40, the double of the 20. So this will be 45. 1 minus. There's somebody who is asking, why, Mwalimu, did you write 1.06? Is everyone able to see how I got 1.06? Is everyone able to get or to see how I got that? Kindly, Luvanda, great. Great. Yeah, it is just the 12% I've divided by 2. The KD, and the 40 semi-annual, that means the number of period increase and the rate decrease. So 1 minus 0.06. Now this is 1.06. 1.06 raised to negative 40. Plus 1,000 times 1.06 raised to negative 40. Kwani zote zinafanana? Yeah, kwa hivyo 1 minus. Sawa. over 0.06. Isahau hapa. Divide by 0.06. Yeah. Divide by, yeah, thank you. Hapo PV-FA, you have to divide. Yes. Ah, you guys are good. Yes. Haya, 45 times. What is PV-FA? PV-FA 6%, 40 years. 40 years. Can you just work out this? 15.0463. 4 decimal places. 15.0463. 4 decimal places, sawa. 1,000 times 1.06 raised to 40. Asante. 1.06 raised to 40. Itakuwa ngapi? Negative 40. Itakuwa ngapi? We discount our redeemable. 972. 0.0972. 0972. That's better. 45 times this. Pata ngapi? 45 times that. You're almost winding it up. 45 times that figure. 677.0835. Plus, this one will be 97.2. What is our intrinsic value? The total of the two. Intrinsic value. That is Roman number 1. Roman number 1. You add the 2. Somebody telling me it's true 2. Sawa. You add the 2. Total is how much? What will be our total there? Ukiongeza hizo mbili. 774, 30, 55. 774, 30, 55. Now, class, that is done. That is the intrinsic value. When the rate is compounded annually, and we have a KD of 12. A KD of 12%. That is it. Now, for the second question, the new value of the bond if the yield to maturity goes down. If the KD is reduced, what will be our value here? Now, for me, I can just replace all this information with my KD reduced, right? All other factors remain constant. All other factors remain constant. The only thing that is changing is our KD. In that case, I'll just come here and replace everything with my KD here. KD. The other things remain constant. So Roman number 2. Class, I'm just changing my KD. KD. Like that. In fact, the others will remain the same. This one will not be like this. So if my KD, or the cost of debt, or the yield to maturity, change to 8%, I want you to give me the value that I'll be using here. It is 1 minus 1 plus KD. My KD itakuwa ngapi? How much will be my KD? 0.04, because it is 0.08 divided by 2. 0.08 divided by 2. So plus 0.04, divide by 0.04. And this 0.04 is the one that I bring here. 0.4, 0.4, and then 0.4, 0.04. Yeah. Now, can you give me the PV-FA? Can you give me the PV-FA for this? PV-FA itakuwa ngapi? Of course, we have reduced the rate, the KD. 19.7928. 19.7928. What about this one? 1.04 is to negative 40. 1.04 is to negative 40. 1.04 raised to negative 40. 0.20, 208.29. 0.2083. Allow me to use 4 decimal places. So in that case, I am able to get that 45 times 19 itanipatia nini? 45 times 19. 45 times 19 ni ngapi? 45 times 19.7. 890.68. 890.68 plus 208.3. 208.3. Aha, the total should be 40. Huh? Which 40? Which 40? Aha, Omundi. Ni gani 40 pale? Which 40 now? Yes, so what will be the total? The total. Uliosema 40 gani? 1098.98. 1098.98. Something close to that. What can you deduce from that? I thought it's 8%. Interest. KD is the one that changed. Interest should be 40. Which interest? I'm not getting. Francisca, am I? Interest, hapa. J. This was the YTM. Whatever that changed, look at here. The new value. If the yield to maturity, YTM. Hello? You see, 45. Kawaida tu, hiyo haina maneno. Kawaida, 9%. A half of this. Tafadhali. You now don't come and use YTM as interest. Tafadhali. Don't use YTM as interest. 9% does not change. Yes, that one hakuna mahali tumeambiwa ina change. The other factor remain constant. Great. Do you understand now? Yeah, other factors. I mean, the only thing that we've been told, the new value of the bond, if the yield to maturity goes down to 8%. Yes, it is the 12% that has changed. So we have shifted from 12% to 8%. 8%. And you can see the effect. You can see the effect of that. Reduction in the cost of debt. Reduction in the cost of debt increases the value of the bond. The value of the bond goes high because the cost has reduced. Wakati wamekupunguzia kidogo, wanaongeza. All right. You know, when you are borrowing loan, kuna cost mingi wanaekaga pale. You multiply by 2 and not divide by 2. Yes, for the period, if it is a semi-annually, period double. For the rate, divide. If it is quarterly, for the period, what do you do, Grace? If it is compounded quarterly, for the period, what shall we do? For the period or the number of years? I want to see whether you multiply by how much. I just want to have interested with your multiply by how much. You multiply, yes, by 4. You multiply by 4 if it's quarterly. Multiply by you multiply by 4. You multiply by 4, and the rate, end rate there, you divide by 4. You divide by 4, and that is it. Let's now look at another question here. Write that down and say that Grace Limited is currently issuing 9% bond. Grace Limited is currently issuing 9% bond, redeemable at 100 shillings. Grace Limited is currently issuing 9% bond, redeemable at 100 shillings par value. Redeemable at 100 shillings par value. So it's 9% bond, redeemable at a shilling 100 par value. Redeemable at shilling 100 par value in 5 years time. This unauliza aje? So N is 5 years. In 5 years time, full stop. Alternatively, each bond can be converted on that date. Alternatively, each bond can be converted on that date. Alternatively, each bond can be converted on that date into 20 ordinary shares of the company. One bond converted into 20 ordinary shares of the company. Into 20 ordinary shares of the company. The period you multiply, right? If it's semi-annually, by 2. If it's compounded quarterly, period you multiply by, period your number of years, multiply by, depending the how much is it compounded. Mara ngapi kwa mwaka. Quarterly inamaanisha ni mara 4. Semi-annually imekuwa mara 2. Of the company. The current market price per share is 4.45 shillings. Current market price is 4.45 shillings. 4.45 shillings. And this is expected to grow at a rate of 6.5%. Growth rate. Ni vizuri kufanya hii analysis. 6.5%. Expected to grow at a rate of 6.5% per annum. For the foreseeable future. Full stop. For the foreseeable future. Full stop. The company cost of debt is 7% per annum. KD. 7% per annum. The company cost of debt is 7% per annum. Required, Roman number 1. Required, Roman number 1. The ceiling value of the bond. Ceiling. Ukitaka vizuri, unaweza kuja hapa useme highest value. Highest value. Number 2, the floor value. Floor ni chini. Hii ni lowest value. And then conversion premium per share. Number 3, conversion premium per share. Maybe to note, if you are to compute the conversion premium per share, you look at the value of share in the future, or the difference between the value of share in the future and the value of share today, the conversion value today. Conversion value in the future and conversion value today. That difference gives you the conversion premium. The conversion premium. The difference between the value of the share 5 years, the value of the share today. Difference. So I want us to solve this question. And from this question, you can identify that it's a conversion question, but there's something that we said that we are drawing line to. That if it's a conversion question, there's something that is already known. What do we know first? What is known? What is known? Yes, it's a conversion. We don't know conversion value, but we know something else. What do we know in this question? What do we know? The start point. The start point. Something that we know. We know the redemption value. We know the redemption value. How much is our redemption value, class? How much is our redemption value? How much is our redemption value? Ningapi. It's 100 shillings. Therefore, the start point of these of getting solution to this question is for you, first of all, to get the conversion value. Right? Get the conversion value. Calculate the conversion value. And it is the conversion value in the future. And our future will be after 5 years. Now, what will be my market price after 5 years? What will be my market price after 5 years? Am I going to compound this 4.45 or am I going to discount? Very nice question. And that's why I told you that topic number 4, the time value of money, is applied in almost all the topics. I want to get the future value, and therefore I do compound. Thank you so much for that. We are going to compound our 4.45 in order to get what? To get the future value. So I know that to get the future value here will be given by the present value times 1 plus r raised to, I want to test something, negative n. Is that formula correct? Is that formula correct? Wamekataa. What might be the problem with the formula? And there's somebody who is not sure whether it's correct or not. Watu wa kusema, I'm not sure when you are over the fence. Over the fence. Yeah. N should not be. And remember, we are going forward. We are going forward. So our N should not be a negative. Our N should not be a negative because we are going forward. We are looking for the future value, right? Negatives is when you're getting present. Great. That's very good. Once you know that, it becomes very easy for you. So since you're getting the future value, we move forward. We add at the positive. Ni vile tu huwa hatuiweki. There is an implied what? Positive sign like that. But if you're getting the present value, tunakuja nyuma, tunatoka future, tunakuja. That is the case. So in this case, my present value class ni ngapi? 4.45. Now, in my case here, my R is the growth rate. That rate. 1 point, of course it will be 0.65 raised to how many years? 5 years. Raised to 5 years. So what will be my market price after 5 years? After 5 years. Takuwa ngapi? Market price after 5 years takuwa ngapi? 6.097. 6.097. Now, if one board is going for 20 ordinary share, 20 ordinary share, 20 ordinary share, ordinary share. Now, in that year 5, after 5 years, these bonds, what will be the conversion value? What will be the conversion value of these 20 ordinary, 20 ordinary share. It will be this 20 ordinary share times the price, times the price, times the price, times the price, the value after at that point. So because I know if I want to get the value of a bond, the value of a bond, I take the ordinary share times the price, So our conversion value will be, is equal to ordinary share times the price, And our ordinary share is 20 times the price of 6.097. What will be our conversion value after 5 years? 121.94. 121.94. Now, this is where we draw the line and we come and check what was our redemption value. Redemption value, guys, gave me 100. Now, between the redemption value and the conversion value, which one is higher? This is the only task that we have. Between the redemption value and the conversion value, which one is higher? Of course, our conversion value is higher, and it is the one that we use to compute the ceiling value. And you remember the formula? The formula now, when it comes to conversion here now, any other thing remain constant. Please note that any other thing remain constant. If it is computing the interest, we compute interest using the redeemable or the redemption value, the par value. So it will be market value is equal to the interest. You discount that KDNE plus. Now, the only change is that here now we bring the conversion what? Conversion value times PVIF, KD, and ES. But hizi vitu zingine remain constant. The only thing that we now bring as a new one is the conversion value there. And then we do it correctly. So how do we get interest? 9%. Hii haina mambo na sijui semi-annually, quarterly haina. It's just 9% of 100 times 1 minus 1.07, because my KD is 7, raised to -5 divided by 0.07 plus 121.94 times 1.07 raised to -5. Class, can we solve this? Give me the first not visible. Which is not visible? Okay. Mwana misi ni gani? From my end naona kama iko visible unless your network bandwidth is somehow weak. And what we said, if you find such, kindly log out. And then formulas tuko nayo bwana. Kitu tulikuwa nayo. So interest, you discount interest. Then you add conversion value, you discount your conversion value. And the conversion value happen at the end. You see this one, we have gotten it after 5 years. Wanamisi. Hii formula hata tuko nayo, tulikuwa tumeianalyze mahali. You discount interest. Then you discount conversion value. So the first one tunapata nini? Of course, the interest is 9. The interest is 9 times. What is the PVIF? PVIF 5 years 7%, 4.100. Plus conversion 121.94 times 1.07 raised to that, raised to -5, raised to -5, raised to -5, na kuwa ngapi? Itakuwa 0 point something, si ndio? 0.7130. Now, can we open up this? Let's open up this. 9 times 4 itakuwa 36 point something, si ndio? Hiyo 9 times 4. 36 around there. Hapana, si 3.9 bana. 9 times 4. 36 point something. I know that. 36.1. 0.9 or 0.1 or 0.9? 0.9, 36.902 plus hii nayo itakuwa ngapi? 121. 121 ukimultiply inakuwa ngapi? So that we get our value there. Haya, hapa ngapi? 171.027. Aha. Aya. Hapana. Bwana, if you multiply this one 21.94, if I multiply with this one, I know it will be less than 121. You see, hii ni 0 point. Wewe. Linet, namna gani? It's a 6.94. It's a 6.94. Yeah? Then you add the 2. Add the 2 now. Add the 2. Ama sasa ulinipatia kitu yote. Acha tuone. Add the 2. Itakuwa ngapi? Now that is the highest value, or highest value, 123.84. That is our what? The value at that point. Class. Kindly, can you proceed and get the floor value? The floor value. Now, which value are we going to use when calculating the floor value? Are we going to still use the conversion value or the redemption value? Floor value is the lowest value now. Yeah, the redemption value. Kama kawaida. Please proceed and get the value, the floor value. Na kama our conversion value ndio ilikuwa chini, ndio tungetumia kwa floor value. So they can interchange. It depends with what you get as your conversion value. Tungepata 90 hapa, hiyo ndio tungekuja kutumia kwa floor value. Juu ndio iko chini, the lower floor value. The higher ni ingekuwa 100, ndio tungetumia hapa. So it is not always that we use the highest to compute the highest value using the conversion. Please note that. And then proceed. Loma number 2. Let's see what you're getting. Loma number 2. The floor value of the bond. Floor value of the bond. Let's see who will be the first one to use the South African rule correctly. South African rule. That is speed and accuracy. Who will be the first one? Remember, your subjected are the same. The conditions are the same. Have the chat box, you have everything the same time. So let's see who will be the first one to use or to apply the South African rule correctly. 108.2. Who is the first one? Kevin. I saw Kevin followed by Bata. Ni kama imekuja at the same time, Miriam and Mweni. The 3. Why? Disaster. That is very good. The 3 zimeingia at the same time, only that they could not pile up mahali pamoja, They could not pile up mahali pamoja, only that they gave each other space. 108, Mary, thank you. So that one, I'm not going to do it. That's the correct one. Anybody with a challenge of Roman number 2? Anybody with a challenge so that we can do it together? Anybody with a challenge? And once you understand and master what is happening, okay, no problem. Anybody else with a challenge so that we can do it together? Okay, now this is what we're saying, that since already our conversion value, we have used it to compute the Joseph. Yes, we say that you can use emoji, a smiling emoji, an emoji that is scaling, like that, so that we are able to move together. Market value will be the same as getting interest, PVFA, KD, years, plus the redemption value times PVF, KD, years, like that. Naona? So hapa tunakuja tu tunatumia sasa 100 times. Of course, it remain the same. Unaona hii? times whatever 1 minus 1.07 raised to -5. Haina maneno, hii ilikuwa tu ujue tu what is happening, plus redemption value which is 100, 1.07 raised to -5. Sasa nikishafanya hivyo mimi niko direct times 4.100 plus are we moving on well? Are we moving on well? Is there any change? 9%, of course, yeah. Oh, hapa tuko na 9% because it's the rate, 9%, 9%, 9%, 9%. Yeah, 9%, 9%, the rate, 9% of that 100, plus 100 times 0.71 that. Higher. So 9%, this will be the same, 9 times 4.100 plus 71.30. So hapa pata 36. Have you gotten the 7% from? It is in the question. Thank you so much, Grace, for answering that. Asante kwa kusaidia mwalimu. 902 plus 71.30. I think, bro, this is the one which is giving people 108. Is that true? Are you getting 108 here? 108 point something. People are getting 0.2 something like that. Great. So I hope those people who had said we repeat this one or we do it together, we are now together. Are we together? Kindly confirm, and you confirm as you dance. If you understand something, you dance a bit. You dance a bit. Thank you so much. Thank you so much. Now the last one is the conversion. Is the last one we are going to look at the conversion premium per share. Conversion premium per share. So first of all, define this conversion premium per share. Say that conversion premium per share, it refers to the difference between conversion value in the future. It refers to the difference between conversion value in the future, difference between conversion value in the future and conversion value today. It refers to the difference between conversion value in the future. Already conversion value in the future is this one after 5 years, and conversion value today. Who can tell us how can we compute our conversion value today? How do we compute our conversion value today? Because it will be the difference between conversion value in the future Already we had it 121. Great. Whatever Miriam is telling us, because we are using the current what? Number of share is 0. The ordinary share is 0, and ordinary share is 0. So we are just going to multiply with the what? With the current market price. So you less conversion value today. Value today. Which is 4.45 times 20. Inapatia ngapi? Hiyo ukichapa hiyo times 20. Hii ni 20. 89. So tukitoa 89 kutoka kwa hiyo tunapata nini? Toa 89 from 121 inakuwa 32.94. And since they wanted per share, so you divide na number of share. Ukitaka maybe probably this one 32.94. If they want per share, you can divide by 20 to get 1 point something, and that will be done. That will be done. So class, that is what that question expected us to do. That question expected us to do. Kindly allow me to give you a break of like 5 minutes, and then we shall be back to look at valuation of redeemable, irredeemable, and convertible preference share. We are done with the bonds, debenture. Tumemalizana. Tumekuwa na irredeemable debenture na tumekuwa na nini? Na redeemable debenture, whereby we have been able to see how we do the conversion. we do the conversion. So a break of 5 minutes. The 5 minutes we are back again. So I hope we are there. We look at valuation of redeemable. Redeemable, irredeemable, and convertible preference share. All right, class, what I would like you to note, the difference between what we've already done and this one, it's only the return. The return. What is the return of preference share or preference shareholders? What is their return? Pale return ilikuwa interest. Hapa ni dividends. Dividends. Preference, dividend. Preference, dividend. Yaani hiyo tu ndio tofauti. So if you are looking at the market value of the preference share, market value, if it is redeemable, the formula will be almost the same, only that now we shall be having the PD, preference dividend, as the return. We are discounting the preference dividend. We are discounting the preference dividend. We are discounting the preference dividend. And that preference dividend will be an annuity. Right? The same interest was an annuity under the bonds. Let's do it. Just say that preference share attract a fixed amount of preference dividend. Preference share attract a fixed amount, attract a fixed amount of preference dividend. Hiyo ndio return. Over a given period. Annuity. Kawaida tu, annuity. And the redemption value, if any, upon maturity. Upon maturity. Next point, to calculate the intrinsic value of the preference share, to calculate the intrinsic value of the preference share, we discount the expected cash flow, using the cost of preference share. Sasa hapa si KD, hapa ni KP, using the cost of preference share. KP as the discount factor. Class, have you seen the game? Have you seen the game? The only things that are changing here is the return. Okay, and the preference share return is the preference dividend, right? That is what we are going to discount, of course, using annuity. It's an annuity. And then if there will be redemption, it will happen at the end of the maturity period. Lakini ni kama iko. Kama haiko, you cannot just put it and it's not there. And then our discount factor will be the preference share or the cost of preference share. The cost of preference share. The same way we use the KD. All right. Preference share of two forms. We have redeemable and irredeemable. We have preference share of two forms. Redeemable and irredeemable. Redeemable and irredeemable. So let's start with the first one. Valuation of irredeemable preference share. 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 You say that these are preference shares that do not mature. These are preference shares that do not mature. These are preference shares that do not mature. Hence, they attract a fixed amount of dividend to infinite. These are preference shares that do not mature. Hence, they attract a fixed amount of dividend. These are preference shares that do not mature. Hence, they attract a fixed amount of dividend to infinite. To infinite. A fixed amount of dividend to infinite. Full stop. The intrinsic value of irredeemable preference share will therefore be the intrinsic value of irredeemable preference share will therefore be the infinite stream, the infinite stream, the infinite stream of expected dividend, discounted using the cost of preference share. Infinite stream of expected dividend discounted using cost of preference share. AP. So ni ile tu. Joseph tumesema kwamba the intrinsic value of irredeemable preference shares will therefore be the infinite stream of expected dividend discounted using cost of preference shares. Cost of preference share. So the market value of preference share will be equal to preference dividend times preference dividend times, of course, PV for KP to infinity. The same way we did under the bond. Now here, since we are dealing with the return of preference share is the preference dividend. It is the one that we are discounting. The return of bond was interest. It is the one that we discounted. If somebody can see what is happening here, they can even be able to tell us what will happen when it comes to the redeemable. To the redeemable. It's just simple. Just simple. Who can give us the final formula for this now after deriving this? The final. Market value of the preference share. PD over KP. Done. Because we say that if PV for R squared n years, to infinite, R squared to infinite, is equal to 1 over R. It is therefore true to say that PV for KP into infinite is equal to 1 over KP. Finally, we can say that the market value of the preference share is equal to the preference dividend, which is the PD, times 1 over KP. At the end, market value of the preference share is equal to PD over KP. As simple as hakuna. Yani, once you understand the concept clearly, things become very simple and easy. Very simple and easy. Thank you so much, Miriam, for giving us this one, for giving us that one. So what we need is this one. So if you're dealing with a irredeemable preference share where you don't have maturity period, kindly, this is the formula. Hakuna kitu ingine you need. Just need this. Derivation wachana, hii ni ya kukuleta hapa. Nisikuje niweke hii direct, shindwe, hii imechange aje? KP imetoka wapi? Class, please confirm whether we are together, whether we are trying to connect the dots. Are we together? Are we together? Kwa pamoja? Are we together? All right, we have a question here. We have a question, illustration. You say that irredeemable preference share with a par value of 200 shillings. Irredeemable preference share with a par value of 200 shillings is to be issued by Omondi Limited. Our class rep is to issue this. Is to be issued by Omondi Limited. Omondi Limited is to be issued by Omondi Limited. I repeat. An irredeemable preference share with a par value of 200 shillings, par value of 200 shillings, with a par value of 200 shillings, is to be issued by Omondi Limited. Is to be issued by Omondi Limited. Is to be issued by Omondi Limited. Full stop. Full stop. Confirm kama tuko pamoja hadi hapo. Before we continue, we together. Great. If the cost of capital is 16%, the cost of capital is 16%. The cost of capital is 16%. Calculate the intrinsic value per share. Calculate the intrinsic value per share. Calculate the intrinsic value per share. Class, is it possible for you to do that question? Tusema unaanza na formula. Unaona hapa huyu examiner alikuwa very wise. Akakupatia cost of capital. Lakini for you, you know cost of capital ni nini? Cost of capital. Cost of capital. Itatumika kama nini? Okay. KP. We have to finish up the question. The interest rate or the preference dividend or maybe you could have started at the start, just incorporate your 18% irredeemable preference share. I think that will work. 18% at the start of that question. Before irredeemable preference share, just say 18%, 8%, sorry, 8% irredeemable preference share. Now that's the rate. 8% irredeemable preference share. So the whole question reads 8% irredeemable preference share with a par value of 200 shillings is to be issued by Omonde Limited. Full stop. If the cost of capital is 16%, calculate the intrinsic value of the share per share. Calculate the intrinsic value per share. So here I know that I need to get my market value of the preference share, which will be given by PD over KP. And our preference dividend will be given by what? Of course, preference dividend, it is the rate times the par. The rate is 8% times par value of 200. So hiyo inakupatia ngapi? The rate times par 16, right? So you can put 16 down here. And I know my KP is 16%. So the answer will be, market value will be 16 over 0.16. Nakuwa ngapi? 100 shillings, right? 100 shillings. 100 shillings. 100 shillings. 100 shillings. 100 shillings. Yes, 100 shillings. I want us to have another one. Say that Mary Unlimited issued a 10% preference share. Mary Unlimited issued 10% preference share. Issued 10% preference shares to raise funds. Issued that 10% preference share to raise funds. The shares have a par value of 100. The shares have a par value of 100 shillings. 100 shilling each. 100 shilling each. And are currently trading at or selling at, are currently selling at 110 shilling. 110 each. Shilling each. 110 shilling each. The minimum rate of return is 8%. 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 minimum rate of return is 8%. Minimum rate of return is 8%. Full stop. Explain whether the shares is overvalued or undervalued by the market. Explain whether the shares is overvalued or undervalued by the market. So the same thing, examiner wants you to get the intrinsic value of the preference share. But you have to now do some calculations so that you are able to see between the market, how much it is selling at, and what you are going to get as the intrinsic value. Is it overvalued or undervalued in the market? Is it overvalued or undervalued in the market? Okay. How now do we solve this question? I can see already we have our rate here, 10% preference share. So my PD is equal to 10% over 100. Because that is my par. My par value is hapa 100. So this will give me 10. That is my PD. My KP, hiyo nimepewa mahali, it's this one, 8%, which is translated to 0.08. Sindio? 0.08. If I want to get now my market value, the preference is the PD over KP, which is equal to 10 over 0.08. Pata ngapi? Shilingi ngapi? 125. 125. Now, currently selling at this, and then predicted this. Now, are the shares overvalued or undervalued? Overvalued or undervalued? How would you advise the investor? Should an investor buy the shares at this point or sell the shares? Kuna mtu anasema overvalued, undervalued. Undervalued, so you advise them to buy. Great. The shares are selling at 110, right? So you advise them to buy. You advise them to buy. You advise them to buy. Yes. So that is it. So the question will come in different aspects. It's for you to just stick with the formula. Once you stick with the formula, they become easy. To become easy. So the shares were undervalued to 110, and therefore advise the investor to buy shares. You buy more shares because they are selling at a lower price. Selling at a lower price. Let's look at a valuation of redeemable preference shares. Valuation of the next one. Valuation of redeemable. Redeemable. Preference share. Valuation of redeemable preference share. Valuation of redeemable preference share. Valuation of redeemable preference share. So we say that these shares attract a fixed amount of preference dividend. These shares attract a fixed amount of dividend. These shares attract a fixed amount of dividend. A fixed amount of preference dividend. Let's just put them in that order. A fixed amount of preference dividend. A fixed amount of preference dividend. A fixed amount of preference dividend. for a given period. For a given period, and that one is into bracket annuity. Kama kawaida tu. For a given period, in that order, annuity. And the redemption value upon maturity. And the redemption value, kama ile tu. And the redemption value upon maturity, lump sum. And the redemption value upon maturity, lump sum. The intrinsic value shall therefore be determined by the intrinsic value shall therefore be determined by the intrinsic value shall therefore be determined by discounting both the preference dividend and the redemption value. Kama kawaida tu, discounting both the preference dividend and the redemption value. So market value of this will be given by, the first thing will be what? What are we discounting at the start? Somebody? Vitu bwana ni rahisi bwana. PD. Sasa in the place of interest kama venye tulifanya hapa sasa ni PD, right? Multiply by PV-FA. Sasa itakuwa PV-FA what? Formula hapa. Itakuwa PV-FA KP, right? Cost of preference KP, right? And yes. Hapo tu ndio imechange. Sasa instead of our KD, we are dealing with the preference, cost of preference share, plus redemption value times PV KP plus N years. Like that. Hakuna vitu complex. Hakuna. Like that. That's the formula. Hiyo ndio formula tutakuwa tukitumia. Redemption is a lump sum. One time. That's why we use PV. This is several time, multiple time. Similar. The preference dividend. That's why we use the PV-FA. The PV-FA. Illustration. Illustration, you say that 8% preference share with a par value of 100 shillings, 8% preference share with a par value of 100 shillings, 8% preference share with a par value of 100 shillings are to be issued. 8% preference share with a par value of 100 shillings are to be issued. Full stop. If the required rate of return is 12%, if the required rate of return is 12%, and the shares are redeemable in 4 years, if the required rate of return is 12%, asilimia 12, it's 12%, and the shares are redeemable in 4 years, and the shares are redeemable in 4 years. Calculate their market value assuming they are redeemed. Calculate their market value assuming they are redeemed. They are redeemed. So they will be redeemed. They are redeemed. Roman number 1. They are redeemed. Wacha tuone penye wanatuguide hapa. They are redeemed. Roman number 1. A, or Roman number 1 is our at par. At par. At par value. Number B, at a discount of 15%. At a discount of 15%. And C, at a premium of 15%. Plus, if a discount is given, are we expecting a redemption value more than 100 or less than 100? Because the only thing that will be affected is the redemption value. Less than 100, of course, less by 15%. If a premium, if it's given at a premium, are we expecting a redemption value which is more than 100 or less than 100? Hi, Jameni, you guys are great. You guys are great. More than 100, it will be 115% of 100, which will be given. And that will be 8. So, when redeemed at par, what will be our redemption value? When redeemed at par, 100. Yani, hizi vitu bwana ni rahisi. Because if I look at my formula here, I just need to get the preference dividend, I discount it, then par, I have it, I discount, and I'll be done. Can you try and do it very fast? For par, hiyo ni direct. Hiyo ni formula 2, and then hii ingine tutaona at a discount. Discount in affect our PD. No, discount is not a we are not touching on discount. The way we did not touch on interest, the same way we are not touching. Whatever that will be affected is at the end, the redemption value with this information. Kindly, can you do the first one? Do the first one. Do the first one. Do the first one. And it's bit, and always start with the formula. Always start with the formula. Always start with the formula. Wacha tuone will be the first one to hit this. Unajua hata kwa mtihani, a question depends on how you understand it. Once you understand the question, it becomes very easy for you to ace that question. So can you do that? That is Mary Ann. Mary Ann is getting 87.85. I'm waiting for 3 more so that we can see whether to proceed to the next one. 3 more. 87.8484. Great, Kevin. Nyinyi watu. This is the time I'm going to invite you here to take us through this. Take us through this. You guys are great. Formula kwanza. Formula muhimu. Once you understand the formula, they become very simple. That is very good. That is an indication that you guys are bright. You are bright. You are bright. You're bright, guys. Bright. So it's simple. You can maybe proceed with that of if you go to that 84.87, you can proceed with the part B and tell me as we continue doing this. So for this one, for the first one, part A, I just need to get the market value of the preference share. And I want to get the preference dividend. I discount that with PV, of course, KPN years. I add my redemption value, PV It will be 𝗃𝗏𝗃 years. Aha, and I have been given 8%. 8% is the rate. 8% preference share with a par value of 100. So it is equal to 8% of 100. That will give me the preference dividend. I discount that with the PV. Do I have the rate? Yes, 12%. That is the rate of return. So it is 1 minus 1.12 leads to how many years? -4 divided by 0.12. 0.12 like that. Plus redemption value is 100. 1.12 leads to -4. Can you give me the value here? Give me the value here. Give me the value of this PVFA. PVFA hapa niko na 8 times. PVFA ni ngapi pale? PVFA hapa 1 minus that raised to that divide by that. Mulipata ngapi? PVFA. 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 Somebody give me PVFA. I multiply my 8. I multiply my 8 with the PVFA that you are giving me there. You can use the table. You can use the calculator. 3.0373. Is it 73 or 75? 3.0373. All right. Plus 100 times what you give me there. 1.12 raised to -4. 1.12 raised to -4. Takuwa ngapi? 0. Takuwa of course ni 0.6355. 6355. Once I'm done with that, I can just multiply. Can you multiply for me that? It will be 24. 24 point something. This one. 24.298. It is good to put all the decimal places. It is good. 298 plus 63.55. That one gave you 87. It has disappeared. 848. Kindly put a big tick in my physical. In the physical class, we usually mark these. Now for you, just mark for yourself. Mark for yourself. A big tick. That is very good. And you can put a good there. That's very nice. So for the next one, at a discount of 15%, class, please note and get this clear. That when you are told that we are dealing with a discount, we expect the par value to change. The only thing that will change is this par value. Discount. At the end of the day, this discount is gotten on the par. The redemption value. Therefore, I expect my everything to remain the same. The only thing that will change is my par here. My redemption value will be 85. Kindly, can you replace 85 there and you proceed? And is V2. Hey. The other things are constant. 78.32 with a discount. People are getting that. 78.6232. You see, when there is a discount, the price reduces, the value goes down. Ukipewa discount ni kama pale kwa bond. Tulikuwa tumereduce from 12, the YTM from 12 to 8. From 12 to 8. It is shooted. Hapa na umepewa discount. What happened? When you compare that and this, that one is low. Higher. What about now at a premium? Okay, anybody with a problem when it comes to the discount? Are we all together when it comes to the discount? The only thing that is changing is this one. 100. It is in fact 85% of 100 because we have been given 15% discount. So hapa tunadina 85. Hapa tu ndio mimi nitaweka 85. Hata nikiweka naweka tu hapa 85 hapa. I multiply by this one. So this one remain the same. The only thing that will change is this value. And this is what I'm doing. The discount here, is 15%. So this is 85. the same, 85. 85. So can you multiply for me? 85 times 0.6355. Napata ngapi? Hapa. Tuchukue hii tuone kama wenye wamepata 78 wako sawa. We have to compare. 540175. 540175. When you add the two, how you get it? Is it 78? When you add the two, 78. 78 point something. People got 78.32. Are you getting that? Is it that? 0.32. Thank you. Now, for the at a premium, if something is given at a premium, we expect it to be at a higher price. At a higher price. So I expect to use 115 here because I'll have 115% of 100. It will be 115. So can you replace that with 115? And we see at a premium itakuwa ngapi? I expect it to be high. 97.8309. Part C. 97.38. Are we all together? Are we together? Are we together, class? Tuko pamoja. So ukiambiwa at a discount, affect your par value. At a premium, your par value still increase. Your par value goes high. Are we together? Are we together? Are we together? Tuko pamoja. Tuko pamoja. And we say that we should be open-minded, right? Always be open-minded. Does the preference dividend affect? No. Dividend, no. Remember, even in our valuation of the bond, our interest was not affected, right? Thank you for asking that question, Mwanamisi. It is not affected. Preference dividend is not affected. So it will become very simple. It become very simple. That is it. That is it. As I want you to have this question, in fact, this will be homework. 10%, 120 sharing preference share. Homework, assignment. 10%, 120 sharing. Yeah. 10% sharing 120 preference shares have a maturity period of 8 years. Have a maturity period of 8 years. Have a maturity period of 8 years. Full stop. The dividend paid semi-annually. The dividend is paid semi-annually. Is paid semi-annually. The dividend is paid semi-annually. Dividend is paid semi-annually. The dividend is paid semi-annually. And the cost of capital is 18% per annum. And the cost of capital is the worst. And the cost of capital is 18%. The cost of capital is 18% per annum. 18% per annum. Question. Determine the highest amount. Determine the highest amount that each share should be sold. That each share, friends, determine the highest amount that each share should be sold. Determine the highest amount that each share should be sold. The same, kuuliza to the same thing. The highest amount that each share should be sold. That each share should be sold. Great. Can you go and attempt that question? Go and attempt that question. Go and attempt that question. So that when we meet next, we shall start with the valuation of ordinary share. When we meet next, we shall start on valuation of ordinary share. That is what we shall start with in our next lesson. This is very interesting as well. Valuation of ordinary share. Valuation of ordinary share will be our start point in our next lesson. How far are we as far as the writing down the short notes is concerned? How far are we? Remember to call a topic, note the topic.